In this video, we are going to analyze one of the most important companies in the world. ASML is the backbone of the semiconductor industry. Only they know how to build machines essential for creating the most advanced semiconductor chips. But for the first time ever, their monopoly may be coming to an end. There are reports that Huawei is testing its own machines capable of producing the best quality semiconductor chips, with mass production planned for next year. And so ASML stock has dropped over 42% from its peak. So today we will answer the most important question. Is the market right and it is the beginning of the end of ASML? Or are investors overreacting and we are witnessing an exceptional opportunity to buy shares of one of the best companies in the world at a bargain? If you invested $1,000 in this company 10 years ago, you bought around 9 shares. And today they would be worth something close to $5,925. And this company also pays dividends, so in that time you would get $325 as dividends. So if we add together both of those numbers, we get $6,250. And that is a gain of 525% in 10 years. That's an impressive return, significantly outperforming the broader market. But past performance doesn't guarantee future results, especially with the recent dramatic decline. So let's look deeper into who's investing in ASML right now. Individual insiders, that is an X, less than 0.1% of the company is owned by individual insiders, and we would like to see this number over 2%. So unfortunately, the management doesn't really have its skin in the game. And are individual insiders buying? That is another X. We actually see a lot of sale transactions from insiders in recent quarters. And do super investors own this company? That is a check with 5 super investors, including Stephen Mandel and David Tepper. And are they buying right now? That is an X. Super investors bought 91,000 shares in the last quarter, but sold 117,000 shares. So while some major investors still believe in ASML, they seem to be reducing their positions recently. And that can be due to either low conviction in the future of the company or due to a high price. Even after the drop, the price still may be elevated. But let's look at what the fundamentals tell us. Return on invested capital, that is a check at 19.7%. And we want to see this number higher than 10%. So that shows that the management is doing an excellent job. And what do we know about net profit margin? It is a check averaging 27.8% over 5 years. And the sector median is just 4.2%. So ASML is absolutely killing it. And now let's take a look at share buyback. It is a check. In the last 10 years, they bought back 10.5% of shares. So long-term investors own a bigger portion of the company without investing any extra cash. And the debt, it is a check. It would take ASML less than half a year to pay the long-term debt with a current free cash flow. That's extremely healthy. So ASML's financial health looks excellent across the board. But now let's look at the growth of this company. Revenue growth, that is a check at 15.2% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so ASML's revenue is growing very nicely. Free cash flow growth, that is a check at 27.8% in the last 10 years. That is excellent. And earnings per share growth, that is a check at 19.6% in the last 10 years. Another impressive figure. So ASML's growth story is very strong. The company is growing revenue at a healthy rate and converting that revenue into cash and earnings even faster. Now let's see how they reward shareholders directly. The dividend yield is 1%, so shareholders can expect to get $6.73 annually per every share. And the payout ratio, that is a check at 32.5%. We want to see the payout ratio between 20 and 50%, so ASML is in the sweet spot, paying a decent dividend while retaining enough earnings to fuel future growth. And what about dividend growth? It is a check at 13.9% 5-year growth rate. That's excellent news for income investors. ASML has consistently increased its dividend payments at a rate much higher than inflation. So we know ASML has excellent financials, strong growth, and a healthy dividend. Now let's see if the current price represents a good value. Let's start by using our PEGI ratio calculator. For those who don't know, PEGI stands for Price to Earnings Growth and Dividend Yield Ratio. It's a simple way to determine if a company is undervalued, overvalued, or fairly priced. So the PE ratio for ASML is 31.5. The growth rate we will use is 9%, which is the predicted industry growth rate. And the dividend yield is 1.1%. That gives us a PEGI ratio of 3.1, which suggests that ASML is currently overvalued. When the ratio is below 1, it indicates that a company is undervalued. But at 3.1, ASML seems quite expensive. Now let's also try a comparable company analysis calculator. We'll compare ASML to its peers. So they have earnings per share of $20.16 and the price at the moment of this recording is $634.93. That gives us a PE ratio of 31.5. And let's compare them to Applied Materials with a PE ratio of 17.7, Lam Research at 19.5, KLA Corporation at 26.6, Teradyne at 21.1, and Entegris at 34.9. When we average these out and apply it to ASML's earnings, we get an estimated intrinsic value of $508, which is below the current price. This also suggests ASML is overvalued compared to its peers. But that is not really surprising. They are the leader of this industry, so we have to pay extra for that market position. Let's also check the dividend discount model. With the current share price at $634, an annual dividend of $6.73, and a dividend growth rate that we will estimate at 8%, being conservative compared to the historical 13.9%, we get a present value of $363. Again, this suggests ASML is overvalued. Finally, let's do a discounted cash flow analysis. So I already entered the 5-year average free cash flow, shares outstanding, and also long-term debt and cash equivalents, which gives us a negative net debt. So they have more cash than that. We are also not changing the 30% margin of safety, 10% discount rate, and 2% terminal growth rate. Now, if you want to play with those numbers and create different scenarios of the future, then you can do that by becoming a Patreon and getting access to all of our calculators. For this valuation, we will create 3 growth scenarios. In the low scenario, we will estimate a growth of 8% for the first 5 years and then 5% after that. This is close to the lowest growth prediction from the management. In the middle scenario, 10% for the first 5 years and then 8%. This is close to the predicted growth for the entire industry, which is around 9%. And in the high scenario, 15% for the first 5 years and then 12% growth. This is close to the ASML's historical growth rate. With these estimates, the intrinsic value in the low scenario is $345, in the medium scenario $409, and in the high scenario $564. After applying our 30% margin of safety, we get $242 in the low scenario, $286 in the medium scenario, and $395 in the high scenario. The share price at the moment of this recording is $634. So across all our valuation models, ASML appears to be overvalued at its current price. The average of all these valuations is around $393, which is significantly below the current trading price. So we do have to pay extra for ASML, but great companies are not cheap. Now let's take a look at the overview of this business to better understand its current situation and its future. So why has ASML stock dropped over 40% recently? There are probably 2 key factors. First, geopolitical tensions are creating uncertainty. ASML has warned that escalating US tariffs and trading restrictions with China are introducing substantial uncertainty into its business projections. ASML now expects that over 25% of its 2025 revenue will come from China. Second, and perhaps most concerning, is the potential emergence of Chinese competition. There are reports that Huawei is testing its own EUV lithography machine, with mass production planned for next year. While ASML currently enjoys a monopoly in advanced EUV technology, this development could eventually threaten its market position, especially since China is ASML's largest market. But despite these challenges, ASML has some major strengths. Their financial health is excellent, with almost no debt and strong profit margins. Their growth trajectory remains impressive. They are absolutely critical to the global semiconductor industry, but for the first time there is a threat on the horizon. Also, the demand for advanced chips continues to grow, driven mainly by AI, cloud computing, and overall needs of modern technology. Now let's open our Stock Ranking Pro, which you can get access to by becoming a Patreon, and see how ASML compares to all the other companies we analyzed on this channel. If we sort our ranking by the overall score, we see that ASML is in the top 10 best companies we ever analyzed. When we look only at the semiconductor industry, it is second. So that shows the incredible quality of the business. When we open the company's overview, we see that it basically does not have any weak points. So while ASML is facing some significant challenges, its fundamental business remains incredibly strong. That said, even at the current price, ASML does appear to be overvalued based on our analysis. And as Howard Marks points out, it's not what you buy that makes you money, but what you pay for it. If you like this video, then you are going to really enjoy my analysis of TSMC, another company that is crucial for the semiconductor industry. Thanks for watching and see you in the next one.